Stocks tumbled today amid concerns that this new budget bill pending in Congress could deepen and probably will deepen the deficit. Earlier in the day, Target, the major retailer, reported weaker than expected earnings due in part to anxiety about the implications of Trump tariffs. To explain all of this and possibly more, Javier David joins me. He's the business editor at the Dallas Morning News and a CBS News contributor. It's great to have you with us. Talk to me about Target and why it is of interest to not just those who watch the market, but those who watch directional indicators in the U.S. economy.
Yeah, Target is one of the largest retailers in the United States. So where they go is sort of considered a bellwether for the market and the retail industry as a whole. So Target had some, political problems that they were dealing with in terms of DEI. That turned off a substantial portion of their customer base. Unfortunately, that was reflected in lower sales. To add on the lower outlook based on tariffs, and they're finding themselves in a position that a lot of retailers are finding themselves in. But there's had the added layer of these sort of PR slash political problems associated with the rollback of diversity initiatives.
Right. They rolled back some of those DEI initiatives, and there was a social media effort to boycott them. And that social media effort appears to have taken some effect.
Yes, indeed. And this is sort of, you get into a lot of this. You had last year with Anheuser-Busch, companies are getting increasingly caught in the crosshairs of these sort of outcries from the public and these pressure campaigns that in some instances can take effect. I think that, during the Biden administration, you had this sort of anti-woke backlash that hit, as I mentioned, Anheuser-Busch and a couple of the other companies. This is, the opposite of that. But still, people are very vocal. Social media is a very important tool to bring pressure to bear on companies when they do something that you don't like.
And talk to me about markets and how they're watching the conversation here in Washington about this large bill that encompasses most of the Trump economic agenda and how it is possibly creating deeper anxiety about not only ongoing deficits, but bonds.
Yeah, look, I have been arguing this for a while now, but today's price action solidifies it. My push is, or my argument, or whatever you want to call it, is ignore stocks, watch bonds. We're not in Kansas anymore. Yields are driving stock markets. You cannot divorce what is happening, first and foremost, with the tariffs, but secondly, with the sort of big, beautiful bill. You have equity investors are kind of eternal optimists. Bond investors are staunch realists. And bonds are really more important because they're the glue that holds the financial system together. So all of these yields, the surge that we're seeing over the last couple of days drive borrowing costs up on everything. It's mortgages, it's credit cards, auto loans, and what the government has to pay on its debt. And the Moody's decision highlighted what, like as that mayoral candidate from New York City once said, the rent is too damn high. The debt is too damn high. You make no mistake. These are like really increasingly perilous times. When you connect all of the dots, you just get a sense that something has changed, something fundamental has changed. And investors are very nervous about the outlook because of that.
And when you say something fundamental has changed, and I love that phrase, don't watch the stock market, watch the bond market. What should people watch for and sort of keep track of on the back of an envelope at their house if they're looking and say, okay, I'm not going to listen for the announcement day to day of what the Dow or the NASDAQ or the S&P did. What should they think about when they hear something related to bonds?
They should really consider their credit card APRs. You got to consider if you're a first-time home buyer waiting on the sidelines, hoping for a more favorable rate. That is kind of like waiting for Godot at this point because they're at 7% and not going to go anywhere soon. Auto loans, if you're considering buying on loan, if you're considering refinancing, these are things that are all linked to bonds, and they are, again, the integument of the financial system. It's banks doing dealings with each other, banks paying out what they need to their customers. There are all of these sort of overnight things, lending that happens in the market that happens behind the scenes, really, that people take for granted. But when the bond markets become unglued and yields start shooting up, you see all of these things start to unravel. And it's, again, stuff that you take for granted, and it's very in the weeds, but it's incredibly important to the functioning of the financial system.
And Javier, very quickly, things are not coming unglued. They're not unraveling, but there are things that you are seeing that are more worrisome than normal.
Indeed, yeah, that is absolutely accurate. But I would just encourage people, again, stay calm. Don't sell. Don't make any long-term decisions with your portfolio. Now is not the time to look at your 401k. Let things settle down for a while, at least.
And let's hope that they settle down indeed. Javier David, thank you so much. I really appreciate that.
Sure.